So we're going to try to make this as exciting as possible because insurance, as you know, is not particularly exciting from the get-go. So you're going to have both of us wandering around the room and doing whatever we can to keep you awake. And we're going to try to keep this to 45 minutes and give you opportunity to ask questions at the end. This is not, unfortunately, it's not simple stuff. First of all, both of us want to thank CCIM for asking us to speak this morning. We're pleased, we're honored, and we're pleased that we're here today. And I want to thank Ken for being a partner on this project. I did have sort of an initial outline, and then we got together, and Ken brings so much wealth of knowledge to the table. It's just, you will see today. It's very impressive. This is complicated stuff, so be patient with us. If you have questions, we're okay with being interrupted until we decide that we're going too slowly. But it is not simple stuff. We've tried to break it down in some sort of logical order. I think and if you want to see slides afterwards, just let us know. Give us a business card, and we're happy to send the slides out to you. What kept my interest in insurance actually was very personal. I bought a property in Salem, Oregon. Insurance came up to bid, and I realized that I didn't know anything about what I was doing, and this was unfortunately way too recently. And mostly, I thought, hey, it's all about price. And what happened is I got a little note in the mail from Umpqua Bank that gave me instructions of what I was supposed to do. And I have 4 or 5 of these spares if anybody's curious to see what Umpqua Bank requires you for your loan for insurance. And we'll be talking about it a little bit more. But, what's an acceptable insurance carrier? Special coverage. They define loss of income, ordinance and law, flood insurance, general liability. And then they also, and we'll be talking about this in our presentation some more, then they also define some topics like coinsurance and how they feel about it. So that totally changed the way I was thinking about real estate. And I think it's, banks are nervous. They want to make sure they're protected. So I think we have this slide here. It takes some analysis to make a good choice. And you need to actually create a spreadsheet. We'll be talking about that. I think we've handed out a spreadsheet on everybody's table for you to see. The form coverage dictates how you're going to be paid. Liability coverages defend you, and your property coverages are the only coverage that will pay you. In other words, give you cash. So if you don't pay attention to what you're buying, and a lot of people don't because they call their insurance agent and they just assume their insurance agent has it down cold and is going to protect them. But the insurance agent is motivated by one thing, and don't let me pick on Ken here. They want the deal, right? Everybody knows that. They want the deal. So what are they going to do? They're going to try to sharpen the pencil so that you choose them for the deal, because after they get the first deal, they want the second deal. And I don't mean to be throwing, just pick on them. Just pick on that kid. But and you have to actually be smarter than that, and you have to actually realize it's not all just about the least expensive price. And that's really what we're going to be talking about today. That's what Ken and I have focused on in our presentation, and that takes us to the next slide, which is mine as well. So we talked a little bit about Umpqua on a recent refinance. They wanted a loss payable endorsement. They wanted special form coverage. We talked about no coinsurance clauses. Loss of income, you all know what that's all about. That's about if tenants, if you have a fire and tenants can't pay the rent because they can't live there or work there, commercial building, you want to make sure income's still flowing so the mortgage is paid. And then the question comes up, well, how long is this loss of income insurance? Is it for 12 months? Because originally in my small mind, I thought 12 months, wow, that's a long time. I shouldn't have any trouble making sure that I can make mortgage payments for 12 months. But then you find out that you can actually buy different kinds of insurance that will that'll go for up to 24 months, and that will cover you until the building is rebuilt and new tenants have been found if that's necessary. So thinking that through, you just need to say, okay, well, do I want to check that box in my insurance coverage instead? Ordinance and law coverage, of course, is critical because we all buy the value-add property. And what do we know about value-add property? It's old, right? And what do we know about Zinsco breaker boxes? They need to be removed. And so, and laws change and zoning changes. And how often does a city change their zoning and not let you know, right? What used to be an R5 is now an R10, or what used to be residential is now commercial. And you may not even be able to rebuild your property in that in that zone, in that area. So you need ordinance and law coverage. Finally, remember, financial institutions, their goal is to protect their interests, because if they have to take the property back from you, they want to be protected. The other piece of the puzzle here, of course, is to consider other financial institution requirements: workers' compensation, flood insurance, general liability with aggregate liability of no less than $2 million. Some of you will buy a $500,000 policy. Some of you will buy $1 million policy. We're thinking $2 million's the new number, and you need to be thinking through, all right, as I'm choosing, what kind of coverage am I really going to need? And then no less than $1 million per location. So if you have a package of buildings and insurance coverage, you're, let's say, a duplex here, a 10-plex there, a 30-unit here, and you have one big blanket coverage, you need to know what your coverage is per location in a term of no less than 12 months. So I think that gets to you.
Yeah, just one issue on this per location aggregate. If you have a blanket policy, let's say that you're managing something for someone, or you personally have 5 locations, and you buy a policy that has a $2 million aggregate of $1 million per occurrence. And if there is no what's called per location aggregate, you only have $1 million per claim across all those properties, and you only have a max of $2 million a year. If you add per location aggregate, that extends that $1 million, $2 million limit per location. So now you've duplicated it 5 times rather than just have that limited limit. So it's really important to understand that if you're talking about a portfolio. If you're talking about 2 buildings on 2 separate policies, then you're not going to blanket, and you're not going to have to worry about that at all. As we looked at the UMQA requirements, they have this paragraph in there about what acceptable insurance carriers are. And actually, we deal in A+, we may have an A- carrier depending on what AM Best, who's a regulating agency, has said. UMQA is B++, class 7, which is not a carrier that we would do business with, but they are allowing those carriers to drop down. That's a pretty low rating as far as today and what we would accept. But they also put in there this wording that says each carrier must be admitted to do business in the state where a mortgage property is located. In Oregon, there's 2 types of carriers that do business: admitted carriers and non-admitted carriers. The difference is admitted carriers have done the compliance work with the state of Oregon to qualify for the guarantee insurance fund. So if that carrier goes down, the state of Oregon will step in for a limited amount and cover their claims until it's completely worked out. A non-admitted carrier may be A-rated, just as not going through those fees and costs to deal with the state of Oregon. We do a lot of non-admitted carriers in Oregon. We don't have any problem because their ratings, we're talking about companies like CNA, who have created different companies to do business in Oregon that are non-admitted. We're talking about AIG. We're talking about large insurance companies who are non-admitted. So this is something maybe that you would push back on UMQA and say, listen, we have an A+ non-admitted carrier, and these are the things that we have in place. So it's important to know the difference between admitted and non-admitted, particularly when you're buying, just so you understand what the difference in cost can be with each one. What's usually included in the standard insurance coverages? We have liability, which is kind of a combination of general liability, professional liability, directors and officers, which is D&O, errors and omissions, which is E&O. All of you real estate in the industry have an E&O policy. We'll talk a little bit about occurrence and claims made. Property and casualty insurance is the combined term that really probably should say more property, but is the only one that's going to pay you. So when you have a loss, let's say I walk onto the property that you own, I trip and fall, that's a general liability claim. You should have taken care of the walk, you should have taken care of the building, I'm going to sue you for my personal injury. Okay? That policy defends you. The fire comes and your building burns down. And now you have to have the building rebuilt, and you have business or loss of rents. That pays you. We don't have a third party involved anymore. We have you and the insurance carrier, and you bought that policy to pay you. So you really want to pay attention to both. But it's really important to understand how the policy is going to pay you. Because on that very first slide at the bottom, it says, and this is the truth, all large claims with an insurance carrier are on negotiation. Even though you may think it's all outlined, if you have a $15 million loss of business income policy, I'm going to tell you it's going to be a negotiation. And it's going to be line by line and negotiated. So you have to understand how the policy is going to pay you and how the policy is going to react, so that when it comes time, you understand, or you have a good broker who can talk about that. We'll talk about coinsurance next. There's several types of different forms. There's basic fire, which used to be the 1960, 1970. We're going to cover fire and theft. There's broad form that kind of got expanded late 70s and 80s into, we're going to add some additional water damage, some other things that show up in the policy. And then they came out with special. Special is everything's covered unless it's excluded. And that's the majority of the policies now are special policies. And you basically go to the exclusions to see what they've drummed out or what they're going to pull out. Coinsurance, deductibles, we'll go through deductibles a little bit. Exclusions, and then we always try to put everything on special. If you have a vacant building, let's say you had a building that's been occupied, you lose the tenant, the building sits there for 60 days. You may have a trigger in your policy that kicks that building back to basic. That policy may automatically say if it's vacant for 60 days, it goes just to fire and theft. Nothing else will be covered. So it's important to understand what kind of trigger you might have in a particular policy there. All right, so the next thing that we had is, as far as special extended coverage, this was the UMQA agreement. And it has a list in here: include insuring against loss of damage sustained by reason of fire, vandalism, malicious mischief, sprinkler leakage, water damage, collapse, including not limited to lightning, windstorm, hail, explosion, aircraft, vehicle, smoke, riot, strike, etc. All those things are in the special form. That's nothing you're going to have to add until we get into things where we talk about earthquake and earthquake sprinkler, and we talk about a little bit of the modifications. We'll also talk about what it says down there in the blue: 100% of the full replacement cost of all improvements to the mortgage property or the amount of mortgage loan plus the amount owing on any senior liens. We'll talk about valuation. Cliff will go through valuation and valuation on policies, what you include and what you don't include in that. So let's go to coinsurance. How many understand coinsurance? Did over should. It's did over should in its simplest terms. You insured it for $1 million and you should have insured it for $2 million. All right? The insurance company has these provisions that say 80 or 90% coinsurance. And that is meaning that they are under the assumption that you at least are going to insure the building for at least the 80% of its value, or at least 90% of its value. And if you don't, there's a penalty, because they didn't want you to buy insurance on 50% of the value. And what is that? It always comes up. It's not going to burn down, it's concrete, nothing's going to happen. Let's insure it for $450,000 instead of $900,000. And I don't pay this insurance cost every year. Well, that's the insurance company's battle against that, is to stick in coinsurance. There's been so many coinsurance penalties that banks don't want it involved anymore. And there's been so many issues where the brokerage community has had to deal with it that we don't like it either. So the goal is to remove coinsurance in its entirety. So let me show you how it works. You have a $2 million for building, and the contract says it's got to be 90%. So at least you're responsible to insure for $2,160,000. The insured limit, you said, no, $2 million. That building's good at $2 million. So maybe it is, maybe it isn't. All right? But in your mind, $2 million is all I want to insure it for. Say, fine, we'll insure it for $2 million. Does it satisfy the co-insurance limit? No, you're 160,000 short. So, reported loss was 500,000. We have a $500,000 loss. We've insured to 0.92% of the value. So the reality is only 463,000 of that is going to be reimbursed, minus the 5,000 for the deductible, and you get a $458,000 payment on a $500,000 loss. And what do? You're pissed, and you call your broker. All right. And this place is ripping me off. They're screwing me. I have a $500,000 loss. That's why the whole thing, removing it, is just to take it completely out of the way. Because this may not happen in year 1. Okay? But a lot of brokers renew policies and don't look at the values, and in year 8, you're still at $2 million. Yeah, that's about right. Okay? And the value's gone up. And the coinsurance, when they figure the coinsurance, is going to come in at 2.2 or 2.3, and you're in penalty, and you don't even know it because you just kept everything at the same value. Okay, and that's why it's really important to review it on a annual basis and to make sure, if at all possible, there's some property forms you won't get it out of, but if all possible to get it out of there, you can. Okay, Cliff, you want to?
Yeah, let's see. Does this work? Beautiful. So coverage you might want that might have to be specifically added if it's not already in special. Of course, we talked about ordinance coverage, building lots, demolition and removal costs of undamaged portion of the building, increased costs of repair or reconstruction due to ordinance or law. So bottom line is some of these policies, if the city decides that, yeah, that was a 10 unit, but now we're only going to let you build an 8 unit, you're going to have to rip out all the foundation. You can't build new. So that's where ordinance insurance kicks in. Back of sewers and drains, I just had this happen to me in a property I own in another state. And we had a water line break. No problem. Insurance company said, you're covered. Happy to take care of it. Fixed all the damage. And then we had a flood. That had to do with water coming. It was a building that was built on slab. I never had this experience before. And water leaked into the building and flooded everything we just fixed. Okay? Not once, but twice. So the second time we had already ripped out the carpeting, and in this part of the country, only half the houses have carpeting in them. The rest of them are tile because they have this happen frequently. And they know, I had no idea, but that was not covered, and I had to pay for that out of my own pocket. So you really have to understand, and backups of sewer and drain is usually not covered. And so you have to know, so how's that play out in Portland? Years ago, for those of you that don't know, on the east side, they had a combined sewer overflow. So the sewer and the storm sewer were one, right? And then they flushed into the river, correct? Willamette River, right? So I'm dating myself a little bit. About 20 years ago, we had a major flood. And we had an office building where we flooded from the drains up rather than from the outside in. We also had some water coming in from the outside, so we had to sandbag the building. But we flooded because there was so much water in the rains from the drains up. That was before the insurance companies, by the way, did away with this language. So we were covered that time, but that doesn't exist. And so what's the issue? You end up with sewer water in a building, and what do you have to do? You have to hire a remediator. They have to throw out lime. You have to test it. You have to make sure there aren't any spores left or something that'll kill somebody. And so it's a big deal. Mold and mildew is often excluded. You have to check on that. Tenant discrimination is often excluded. So if you are in a residential situation, you need to make sure you're protected from tenant discrimination, because if you have an on-site manager or even yourself, you choose not to rent to somebody, and it will happen, and they're green with 5 horns, and instead you rent to somebody else, you have some level of liability if they take you to BOLI, who is now the organization that monitors this, or HUD in Seattle. Employment practices is another thing. You have somebody who works for you that's handling your rentals. You're not covered in your BOP if you don't call it out. Earthquake, we all know earthquake is often not covered in most policies, and you have to decide, well, is Oregon a place where we're going to see earthquakes? So where do we have some of the most earthquakes, right? Mount Angel, right? Everybody knows they have earthquakes in Mount Angel all the time. So if you had a property in Mount Angel, you'd probably have earthquake insurance. It's right on a fault line. Earthquake sprinkler, this is the tricky part. Why don't you weigh in on that?
We have an earthquake, right? And your building's completely sprinklered. Nothing's gone wrong. Everything looks intact, it's fine, except one sprinkler on the 3rd floor twisted and popped off, and now it's leaked down the elevator shaft, and it's gone up through the bottom, it's coming out the front door. Insurance company's going to come in and say, you have no earthquake sprinkler coverage because you didn't add on your policy that in the event of an earthquake, we at least want to make sure the sprinklers are covered. You're thinking it's just a water damage. Well, if it was a frozen pipe, yeah. If it was a pipe that burst or sprinkler head burst, yeah. But if it's caused by the earthquake and you don't have earthquake sprinkler, it's your dime. Yeah.
Is that typically covered under an earthquake, if you have an earthquake policy for?
Typically not. You need to make sure it's in there. Typically when you talk about earthquake limits, you're getting a limit for earthquake damage with a deductible, and the perception is that if it's a bad earthquake, everything's going to go. A lot of times you can get, your deductible on an earthquake is going to be between 2 and 5% of the building's value. And in addition, you may have veneer-only damage, not structural damage. So you may have, facades falling or whatever else. So you need to make sure the language includes veneer, facade damage, as well as earthquake sprinkler. Yeah. So that's a subtlety that you just need to make sure is contained in there, because most of the time, so far in this area, it's subsequent damage that you have, not primary damage from the earthquake.
Your head spinning yet? Yes?
Sorry. But you're awake, right?
Yeah, everybody's awake, but the heads are spinning, right. All right, and then flood. We talked a little bit about flood. I already gave you an example of flood. Flood is, depending on where you are, obviously you need extra flood coverage, and it's not coverage. If you're next to a stream, you're next to a river, even if you're in a floodplain, it's not automatically covered. Sir?
I had a question, really did.
Sure.
So I hear all these various things that we need to be aware of that we really need to know.
Yep.
So my concern is that I hear that, so I'm going to get this, 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 and by the time I get everything that covers everything else, I can't afford the insurance.
Right.
So there's got to be a...
How do you balance it? I think that's a Ken question.
Yeah, well, there is a happy medium, and what you have to do is you have to evaluate where your exposure is and what the cost is going to be. Insurance is paid with net dollars, right? So you got to go out and earn money to pay insurance first. Then you can write off some of the costs, maybe not all the costs. When you're looking at potential, like if you're going to get an earthquake form, it's an underwriting thing to say include earthquake sprinkler. They're not going to charge you more, all right? But it's a detail you have to ask for depending on the company and the form to make sure it's in there. Not everything we're talking about is additional. For instance, ordinance or coverage has A, B, and C. Well, a lot of companies will just issue C. C is in the event the fire burns down, then the resulting coverage of having to rebuild it because of code changes is covered. But A and B could be the biggest part of the loss. And so there's a building on Macadam right now that burned down from the center out. It's right about, what street is that? Virginia, it's further up than that. Right?
It's close to John's Landing. It's close to John's Landing right there.
Yeah, been sitting there for at least 60 days now. And I can tell you right now what the problem is. Nobody's gone in and done anything. Because A was not in the business owner's building ordinance coverage. And that is the city's come in and said the rest of the building has to be torn down even though it's not damaged. So how does he pay for that? It wasn't part of the loss. It wasn't burned or done, but the city comes and says you're going to do. We'll talk about that a little more in detail.
All right, next slide. All right, coverage. Yep.
Sorry to interrupt. What is the insurance agent's responsibility with respect to helping the client understand all of these
Nuances.
It's our duty. It's our duty to sit down with you and go through and explain and help you understand. It's not our duty to make you or compel you to buy.
Right.
All right? So if you choose not to, in our case, we'll document what you did and won, and you'll get it back in a form that says this is what I have decided I don't want. But it's our duty to go through and do a due diligence to see what your exposure is and then communicate.
But not every agent is as equally well trained, and I think that's what we all have to. I mean, so the question is, how do I find a great agent? And I think that's just meeting with them and working on them, and you know, meeting with Ken. Let's keep moving. Let's keep moving. Is that all right? You'll write a note, and we'll okay. Super. Coverage that may not be included that you may want to include. That's not included in a basic policy, typically in a special. Terrorism. We'll be talking a little bit more about that. Named wind and storms, vacant building clause, because sometimes it happens to us, right? We lose a tenant or some tenants, and we have a vacant building, and then we just think, well, the insurance company won't know if the damn thing gets damaged. But the reality is you want coverage if somebody damages your building. A separate crime policy, and then dependent properties business income insurance. And this is a trickier. This is, let's say, this is very sophisticated coverage in my book, and it's if you own a building and you have a tenant in there that makes bearings, and they make bearings for Chrysler, and Chrysler closes up, there's insurance you can buy that will cover you if that tenant goes out. Did I explain that right?
It's dependent property. So if you have a tenant who's only sourced from one place for their business, then you in your lease can require them to get dependent property business income so that if that supplier goes out and they're down for 90 days, you have a source of revenue for your rents to continue to be paid. Yeah.
Would that coverage apply to like a state agency and funding?
Yeah, that's a good question. There's a separate endorsement for that we're, because of our interaction, there's actually a situation where we're working with a company to try to write that particular endorsement to cover, but it's more of a
Niche product.
standalone, unique.
Yeah, niche product. Let's go to terrorism.
So terrorism. Well, back real quick on wind named storms, just moving quickly. Wind named storms, if you're in the South, if you're in Texas, if you're in some place where Florida, etc., if a windstorm, like we got a windstorm off the coast, going to have 60 to 80 mile per hour winds on the coast on Saturday, but it's not named, it's just wind. In Texas, when they have Irma, when they have hurricanes, that kicks in for a different coverage. That ceases to be wind coverage, and it's named windstorm. And if you don't have that provision, if you deal with properties out of state, you have to buy from a certain pool, like a risk pool, to be able to have that. So it's really important. Quickly to terrorism. Terrorism has to be a certified act. Terrorism is a joint act between the insurance companies and the federal government. And the federal government says, we're going to help underwrite this in a pool basis to be able to allow insurance companies to write terrorism coverage. It's cheap. It's cheap. It's a couple $100, anywhere to $900 or $1,000, depending on the size of the policy. It can get a lot bigger, but for the most part, it's $250, $300. But it won't cover you unless it's a certified act. Okay? This picture, Beaver Dam, Wisconsin. This guy was in a multifamily dwelling. He was making bombs.
He was making bombs in your apartment. Can you imagine your tenants are making bombs in your apartments?
And this is the actual clip on this photo of it actually being blown up, because when they found the apartment, there were so many chemicals in there that they had to destroy the apartment. So this goes back to that ordinance coverage where the city comes in and says, we only have this little fire to this one dwelling, but all of it's got to go. So they have to demolish everything. Okay?
Ken,
Yeah.
if he had environmental impairment coverage on it.
If he had environmental impairment, it could be, but subsequently, because there was a fire post, then you would have two pools that you could go after. Yes. But this wasn't certified terrorism. The local sheriff said there was no indication that this guy was lying socially or politically with someone to advance a purpose. So the federal government stayed out, and it's not terrorism. So now you have a cleanup, you have a damage, you have a subsequent, you had a small fire, but now you got a whole pile of building. This is a couple calls worth. This is one write the check, and there's a lot of negotiation going in.
But remember, the sheriff is the one that made the decision to blow this up, right?
Yeah,
And so
right.
Do you think the sheriff is going to go to their insurance and their risk manager and willingly cover this? How many times does the sheriff knock down a door and do you get the check in the mail to repair that door? I don't think so. So that's why this is important.
Explosion is covered under the special form, right? So it is covered, but if there's subsequent damage and they come in and say, let's say it's meth, all right, and it's in the walls and everything's got to be destroyed. If you don't have the demolition to the rest of the building piece, they're gonna write you a nice little check for one apartment and say, good luck building the rest. So if it's there, you want your guy to blow himself up. All right, you got a tenant, you either get him out, but if he can't get out, have him blow.
So the question is going to be, do you think it's covered under tenants insurance? Because we require tenants to have insurance?
That's where we would start, is with the tenant's liability and the tenant's insurance. And then we would see how it leaked into the owners. But we would always go to the tenant first.
Let's go next one.
All right, so policy, yeah.
Well, how do you manage active shooters then? It's not terrorism, but still liability. And are the owners of the property liable for security when someone gets into their building and kills a bunch of people?
That's
For another day, huh?
there's so much. to that.
That's another day.
Ultimately, you can be, depending on what controls and what you knew of. All right. YouTube had an active shooter yesterday. 3 people unfortunately got shot, killed. Police interviewed that lady 24 hours before. All right. Now the police went to YouTube and say, we have somebody who's very upset, who's making very aggressive, and YouTube said it's not going to bother us. We're going to leave everything open. Then you're going to have an issue under the contract. Anyway, you can talk to any of the attorneys about what some of the liability is going to be, but under the contract, you're going to have an issue about whether or not you were protecting or mitigating your loss. But ultimately, if you weren't grossly negligent, the policy would initially step in and defend you until the facts were found.
Mark, did we need to get, Mark, do you have that question? You're cool? Okay.
All right, so a couple policy basics. You got to make sure the right first named insured is on the policy. Okay, if you have a policy with, and several of you, if you have multiple properties, are going to have several named insureds. You want to make sure they're on there, okay? Because if you get sued and the name isn't on there, the policy won't defend you in the suit. So the way around that is you have your attorney contact the plaintiff attorney and say, sue us in this name, because that's under the insurance policy. But if that name has nothing to do with it, then that name's not on the policy's not going to respond. In addition, it's the first named insured that gets all the premium notices and the cancellation notices. So if you're in an LLC and you're not the first named insured, you're not going to get notified if the premium wasn't paid or it's vacant. So make sure how the policy's read there. Not owned and hired coverage is becoming the fastest growing area, particularly in some industry segments, of huge claims. Okay? And that is when your employee says, I'm going to go make the deposit, hops in the car for your company, runs down to the bank. On the way to the bank, in the intersection, they take somebody completely out, a family, all right? That's not going to cover their car. It's not going to cover their liability. But somebody may look around to sue you to send that person because you didn't know that they had a DUI, they had 2 tickets, somehow you were negligent. If you don't have not owned and hired, that's going to be an issue where it's not going to respond to you in the policy. Retro date, we'll talk about claims made here in just a minute. The other thing is important to know is what the policy is going to pay. Actual cash value is replacement cost minus depreciation. Nobody really wants that. So you need to make sure that ACV, companies will pay you, even on replacement cost, they'll pay you ACV first until you prove up the loss, then they'll redeem you for the total replacement cost. Agreed amount is when we say there's no co-insurance, this is a $2 million building. If it burns down, I may not rebuild it as it is. I want my $2 million to decide what I'm going to do. So you get agreed amount in the contract, nobody cares. I had a horse butchering facility in Redmond, Oregon next to the propane tanks, right? And Earth First was really pissed off at these guys and came in one morning about 4 a.m., tossed napalm on the whole place, all right? They got the horses out, fire department went out, turned around and put everything on the propane tanks while this building burned down. Didn't put one piece of water on it, kept all the propane tanks. Building was insured for $800,000. It was probably a $3 million building. The guy was from France. We put a agreed amount on it because he was not gonna, he had so many protests, he was never gonna rebuild there. He wanted the 800 grand, he'd sell the land for something else, and he was moved. We wrote him a check for 800 grand, nobody said anything, and it was done. That's when it works pretty nice. And then professional fees, real quickly, two things, professional fees and defense costs outside the limits. If you had a $2 million business income loss on your building, the insurance company is going to go out and hire an individual firm to prove up that loss, an individual CPA out of Denver, San Francisco. They're going to say, all right, I want all your records. Well, you better make sure, and policies will include professional fees in your policy too, so that you can go out and hire somebody individually and have them prove up your loss so your CFO isn't spending all day trying to figure out this loss. It can be automatically included, it's not extra premium to be able to, you know, depending on the size of your policy. So, all right. Cliff.
Okay, valuation. So the bottom line is so how many people have insured a building for what they think it's worth, right? So you bought it's on the tax records at $1 million. That's what it's worth, right? Or in this case, it's worth $680,000, but the insurance company might tell you your property insurance should be valued at $1.2 million. So who's going to step up and say, no problem, we'll do $1.2 million, right? Everybody, right? Raise your hand. You go $1.2 million, no problem. Due to increases in current construction costs. But the challenge is you may not have a choice. If you want to get coverage, you may have to step up to the level. Even though you just bought it for $680,000, you may have no choice but to step up to a higher value. And what's more confusing is that you'll go to three, and we'll talk about this in a couple minutes, you'll go to three different insurance companies, and do you think they're going to have the same $1.2 million value? Absolutely not. Why they don't have a centralized database, I can't figure out. But they don't. And so you're going to compare apples to oranges to bananas all day long till you figure out how to get covered. You'll see an attachment sheet that's on everybody's desk, table, which sort of compares some of those different values. It's blue. You'll see that three different insurance companies. Two of them were about the same place. One of them said, let's value it at $842,000. So this is actually a true example of what we recently did. Additionally, you need to make sure that you have guaranteed replacement costs. We already talked about that. I don't want to be redundant. And of course, don't forget, you don't need to insure the land. So if you bought it for $680 and 20% of it's land, you think you should be able to discount the land out, right? So you have to be doing some grilling with your insurance agent to get where you want to get. Deductibles, next slide. This is also from the little boxes from Umpqua Bank. Excluding earthquake insurance, maximum deductible is the greater of $10,000 or 1% of the loan amount. So if you're thinking that you want to have a $15,000 or $20,000 deductible on your building, you may find that your loan documents won't allow that. And so you need to be paying attention to that. You can reduce the cost of your insurance premium by increasing your deductible. You can self-insure. $5,000, $10,000 are common. But as we point out, $50,000 above, the insurance company may ask for financials. But I think the key here is that the incremental increase of going up in deductible is very, very small. And it actually pays to stay around the $5,000 level.
They're terrible. Deductibles are a terrible buy unless you're going on. You're getting into the 50 and 100,000, and you have a large schedule. But to go to 5 to 10,000 for the $150 it's going to save you.
It's not worth it.
It's
Right.
not worth it.
All right. So next slide is an interesting slide. This is about claims made versus occurrence, and Ken is going to spend a couple minutes on this because it's not simple, and if you don't get it, it's okay.
Yeah, it's fine.
Take it away, Ken.
So
Do you want to tell your story? Do you want to tell your story?
Yeah,
And
I'll tell it.
yeah, I think that's what you might want to do.
So it's 1986. It's 1986. Jacob Marlowe, Oxnard Dunes. Jacob is 81 years old. He's a developer. He developed a lot of properties and residential tracts in Oxnard, California. In 1967, when Jacob was doing it, the city of Oxnard came in and said, hey, you can use tailings from the drilling fields to prove up this sand to get a good compaction rate. so that you can put slabs in here and build houses, and that'll meet our compaction rate. This stuff is good, and it's gonna stay right there. He says, great. He builds 52 homes in this tract on this basis. Goes through his career. He retires in like 1976, 70 something. He's just enjoying life, having a good time. And one day he gets served with a lawsuit from the Oxnard Dune Estates, et al., for $9 billion. Right? And he goes, he does kind of what you did. This is kind of a joke, what's going on? Well, one day one of the homeowners went out to plant a tree in their backyard. And they dig a hole, plant the tree, to get about that, and it's Jed Clampett. Up comes bubbling crude, right? Thinks he's found an oil strike. But these tailings have liquefied, and they've pooled in the property. So this freaks out the homeowner. He starts talking to other homeowners. A couple other homeowners, not everybody, find a couple little pools in their backyard once they start digging and finding where some of these things are. Subsequently, they all collectively are going to sue Marlowe. So they sue Marlowe. They stop paying their mortgages because their property's worth crap now. All the mortgage companies join in and fall into the lawsuit to defend and go after Marlowe for the back payments on the mortgages, the property values. There were some eluded physical type of amenities that happened, nothing like that. So, Jacob Marlowe calls us. We were Aetna at the time. I was working at Aetna, and says, I want to file a claim under my 1967 policy. Okay? We look at the policy, it's occurrence, and under his 1967-1968 policy, we stepped in and defended him and looked at what the claim was going to be, and then the whole thing went through with the claim. An occurrence policy doesn't have to happen during the year of the policy. It covers, in other words, 1986 kicked back to when this was initially done, and that was the trigger for the loss. And because he had an occurrence policy, all those other years kicked back in. If you had a claims made policy, the only policy that would respond in that particular claim is if he had a policy in 1986. Okay? All of your E&O policies are claims made. 99%, I'm guaranteeing they're claims made. So the only thing that gives you that occurrence type coverage is called a retro date. So you want to look on that policy to see when the retro date goes back to, because that's when it starts and going on. If you're going to sell your business and you have a claims made retro date on your policy, you're going to be asked to buy tail coverage for 2 to 5 years. And that is after you leave. That extends that claims made policy for 2 to 5 years in case something comes up and you're like Marlowe in retirement. All right? But it won't go out 30 years like an occurrence. So if you own a business, an ongoing business, and I tell my senior housing clients this all the time, from the professional liability side, we'll change to an occurrence the day before you sell, all right, or the year before you sell, I mean. So we have that occurrence policy going forward, and it will save you the claims made tail cost in going forward. It'll cost a little more, but it'll save you for the 3 to 5 years on the back end. That's probably the easiest way.
Yeah, I think that's good.
Anybody to add? Tom, you want to add anything on that? All right, you sure?
Mark had a question.
Mark?
What about like on a property where there's like contaminant possibilities, that type of thing? Can you kind of protect yourself as a new buyer on something like that with that kind of?
Yeah, in a number of different ways, not all insurance. Hiring Jim Brown for it, Mal Foster and doing that, but then you can also buy liability policies out there, environmental liability policies, that will cover you for a period of time after the sale, a limited, usually period of time. It can go up to 10 years. If anything comes up post-sale, that would require remediation or such.
So like one way that, let's say something doesn't have a full clean bill of health thing from DEQ, that you could possibly get to kind of cover your client if it's sort of in the interim thing, you still want to pursue it. That might be a way to cover them in a time period that would reveal something, or not reveal something by a certain time.
And you can slice it up for administration costs, for cleanup costs. You can kind of play with what the coverages are going to be for that.
Loss rents, we talked about that a little earlier. I don't think I have to dwell on it too much because I went over it a little earlier in the presentation, so I'm going to skip to the next slide, which we're going to do together. So it's important, we're closing into the end here, it's important that if you have a claim, you're well prepared, you know what you're doing, you've got the right insurance, you have copies of your insurance certificates, you know who's going to clean up your property if there's a claim. You know, if you have a flood or fire, you have it secured right away. Most insurance companies want the property secured right away. You want to have photos of the damage. And
The best process in a loss is to act
ahead.
like you don't have insurance. When,
Right.
If you have a water leak or you have, with this rainstorm and you lose a roof or something, act like you don't have insurance at all. The contract requires you to mitigate your loss. And if you stand around and you say, I'm going to wait until the insurance, and you could have done something to prevent the loss, the carrier is going to create a problem with you around that. So you act like you don't have insurance. And the question I always ask is, tell me what's in, just take a picture, a mental picture of your living room right now. And can you write everything in your living room down? What's there? Because if it burned tonight, that's what you'd have to do. So there's nothing like a photograph. And the same thing happens with buildings. Believe it or not, you do an improvement to a building, but the only picture you have is 4 years old. And it doesn't cover all the improvements, or it's not an active picture. So with your phone right now, super easy to do, no reason not to do it.
all right, I think let's go to the next slide, which is really the insurance checklist. I thought I'd take 2 minutes on this real quickly because I know it's almost 1:30. So if you have this, just take a peek. And you can see, we talked about replacement value, we talked about the land, we talked about deductibles, we talked about business, personal property. In this case, loss of rental income is capped at $25,000 per building per year. The other one is actual loss sustained up to 12 months. The per occurrence coverage, we talked about 1 million or 2, and then aggregate coverage. Guaranteed replacement cost, in this case, ordinance coverage. Notice that when there's a blank spot, it's not part of the policy, so automatically. Medical expenses, some companies do 5,000, some 10. Terrorism included for extra money. In some cases, it's not included. And then the question is, what is really terrorism? We talked about that today. Mold included or excluded. Notice it's excluded. Pipe breaks excluded. Flood insurance excluded. Earthquake excluded. And what was the cost, and how do you choose, and how strong was the carrier? So this just gives you a place to start as you're trying to evaluate. Of course, we flooded you with more information than you knew what to do with, but let's leave it open to questions unless you want to add something, Ken. All right.
Jim?
Go ahead, Jim.
Keep your insurance policies, don't throw them away.
Keep your contracts.
Yeah, I had a client with a major gasoline leak. Her business attorney had told her 3 months before to get rid of her both policies, and her parents had coverage back to the 30s. So she found out, 3 months later that she could have had coverage, and it was out of pocket.
True story, all right? True story. Southern California, Stringfellow acid pits in Veruca, California. This guy opened a dumping station for all these kind of waterborne chemicals and stuff on fractured limestone. Goes through, seeps down, goes down into the city, okay? When federal government comes in, CERCLA, they come in and say, we're going to have everybody who ever dumped here is going to have notice, going to have to come in and defend and is a responsible party. I was at Aetna. We wrote $2 million in defense funds on a 1947 receipt that a guy brought in that says this has the policy number and the Aetna. And it was an Aetna policy number during that time, although Aetna had no records. But we were compelled to write a check because they had evidence of an insurance policy back to them. And $2 million later in defense funds off a receipt. So yes, keep them. If you microfilm them, do digitally, do something and store them. Any other questions?
Thank you so much. Right?
Yeah.
Thank you so much for allowing us to
Appreciate
make this presentation.